All right, welcome to the money webinar. I know a lot of you are holding back from investing because you don't think that the money is there. You either don't have the money personally or maybe you don't believe that the money is out there for you. But I'm going to tell you, I have made almost all of my money in real estate leveraging other people's money, either partners or private investors and hard money lenders. So there are a lot of different ways that you can get involved with investing without any of your own cash. Where is all the money? Well, let's talk about that. Hopefully you understand money mindset. What's between your ears definitely affects what is going to happen in your business. There's money everywhere. It's all over the world, you guys. It's literally everywhere. Understanding that, believing that, knowing that, and then going and finding it is the important part. So we're going to walk you through tonight all of the different places that you can find money. And I shouldn't even say all because this is not a comprehensive list. This is a list of the most common ways and some of the easiest ways for you to be able to have money for your deals. So the power of other people's money. OPM is a term that's been around the industry for a long, long time. Some of the pros definitely decreases your risk because other people's money is at risk. You still want to be careful with that, but it's so nice that you're not risking your retirement or possibly risking the equity in your own house. It opens doors that would otherwise be closed for sure, because if you're limited to the amount of resources that you have to use, that's going to obviously end when your money and or your credit power ends. So if you then expand to everybody else that you know and their money limits, their cash, their credit, their ability to go out there and borrow money either on their name, on how good the deal is. Sometimes there are lenders, like hard money lenders, that will lend just on the deal. You don't even need it in your name. But if you expand through everybody else's circles, you've got their retirement money, you've got equity in their house. I've had people literally take home equity lines, pull some of the cash out of their house, do a deal, make some money on it, put that money back that they borrowed, and have some extra now for the next deal. That's a possibility. Some of the cons, yes, actually it costs money to borrow other people's money. You're either going to share a percentage of the profit with them if you partner, or you're going to have to pay an interest rate and sometimes points and interest. We'll talk about that in a little bit. And it does create that risk for others, so you have to be mindful of that. You're sometimes bound by guilt a little bit, and you want to get past the guilt and understand your intentions are pure. If they're not, you need to go back and clean them and make sure that you are borrowing money that is intended for making money for the other person as well, not just for your own gain. So remember that if you can leverage through everybody else's money, that last pro on that list speeds up your investing timeline. Very, very true. Maybe you could do 10 deals at once or 5 deals at once instead of the one that you would be limited to at a time with your own resources. So doing a deal without your own money. Let's talk about using it for rentals. How about wholesaling? How about fixing and flipping? Okay, think about those different possibilities. Now, let's take the first one, being rentals. Let's talk about what you might be able to do to get a rental and start cash flowing, even if you have none of your own money invested. So if you're going to purchase a rental, there's usually going to be a down payment. That could be someone else's down payment. You could do the work of the deal. So you're the equity, like the sweat equity partner, and they're the cash partner, and then you guys split not only the cash flow while you keep it as a rental, but whenever you decide to sell it, then you get to split the profit that is also known as equity as well. With the wholesaling, what you can actually do is, again, leverage other people's money. So possibly in this situation, you use a transactional funder, and they're going to loan you the money that you can then purchase the property with and resell to someone else, or a different way to do wholesaling that actually isn't a buy and a resell, but a pure wholesale flip. You can actually put the property under contract, and then you can just assign the contract to somebody else. So the other person, if they have their own cash, they can go to closing and buy the place, and what they pay you is an assignment fee. That is actually one of the easiest, fastest ways to make money in real estate. Steve, are you there?
Yeah, I was just going to comment that some people may not be familiar with the term of signing a contract. Basically, what that means is you're just going to sell the contract with all of your rights attached to it, and somebody else just simply steps into your place.
Excellent. Thank you. And this idea, this mindset that money is everywhere, if you're unfamiliar with it, let's just talk about that for a minute. Knowing where to look for the money is definitely a part of it. Knowing how to ask for the money is another different part of it. It takes a little bit of work, takes a little bit of people skill, and that's one thing that we help you guys with. We have scripts, and you can actually practice with us to role play and learn how to ask for the money. Having your numbers right on the deal is an important piece of that, so that you know what you're asking for and you can explain to them very well what you're going to be using the money for. That gives them a level of confidence and trust in you. And then also another really important thing is, how do you meet the money holder's requirements? Like I mentioned earlier, there are some lenders that will loan just on how good the deal is, but there are other ones. Let's take a conventional loan, for example, where they have a lot of requirements, a big long list of things you have to check off and qualify for before they're going to loan you that money. The partnerships and the private money are somewhere in between those requirements. The really loose of some hard money lenders and the really strict of conventional lenders, and partners and private lenders will have their own requirements. Steve, do you have anything to add to that?
No, very good.
Okay. So let's talk about different sources of money. Some that are very easy, right out of yours or someone else's checking or savings accounts. Someone's IRAs, it only takes usually a few days to maybe 10 days to get the money moved around, depending on if it's in a self-directed IRA or what type of IRA it's in. And then also credit cards. That's a very fast way to pull money. A lot of times you won't want to use credit cards for a whole purchase price on a property, but a lot of times credit cards are good for, say, fix-up money or carrying costs. And then some of the less accessible types of money that will generally have stricter requirements and take a little bit longer to borrow. The conventional lenders, the hard money lenders, private money lenders, sellers, and investment properties. And by the way, sellers that have cash in their house that we call equity, that is one of the best ways to get financed. It's not the most common way. You have to find a seller that's willing to do that for you. But seller financing is a wonderful way to leverage other people's money. And remember that hard money lenders can be pretty fast as well, depending on their requirements, how much cash they have available, and how familiar you are to them. A lot of times, the better they know you, if you've done a deal or two with them, the faster the money comes to you. So literally, some hard money lenders can have that ready in a few hours as well. And then it could kind of flip-flop over to the easily available side. But they do still have requirements, and so it's not as easy for sure. It's just writing a check out of checking or savings. Steve?
Sounds really good, Christine.
Okay, awesome. Now, there are some things you need to consider. When you're thinking about using your own money or other people's checking and savings accounts, you might want to get set up through an entity so that you can actually run all of the expenses of the business through an entity instead of through your personal checking or savings account. This is something that we actually really recommend that you do. Maybe not on your first deal, but it's important to limit your liability so that you don't have all of that personal liability mixed in with your real estate investing. And a CPA can help you, or if you've got a really good tax accountant, they don't necessarily have to be a CPA, but someone in that category as a professional can help you figure out all and the most and the best tax deductions that you can take.
Yeah, and along those lines, it gets a little bit murky and difficult to take tax write-offs and prove what you spent if you're taking that out of an account that you're also spending on personal things. And so if you set up a separate account for your business and you don't mix any of your personal business with it, it makes it a lot easier to claim your taxes and not get audited and end up in trouble.
Yes, amen to that. So if you guys plan to be investors, we do know that some of you are going to try it and not necessarily like it. we would then recommend you try a different technique or a different piece of real estate and not just give up right away. But we know that it's not something that everybody's going to stick with long term. And then you might end up with a lot of entities like LLCs, S Corps, C Corps, things that you actually don't need, that you pay quite a bit of money and spend some time setting up. So just remember that we want you to get one as soon as possible, as soon as you know for sure you're going to be using it, especially more than once. But even if you can get one set up fairly inexpensively, like a basic LLC on your first deal, that would be good. And then when you do that, you'll have a checking account in the name of the business, and you run all of your business expenses out of that account. That's what Steve's referring to. So when you're taking money from an IRA, there are some rules that have to be followed as well. That's why it's important to have an IRA custodian. So whether it's your IRA or your investing partner's IRA, make sure that you follow those rules that are set there. You don't want to get in trouble with the government. That would just not be very fun. And self-directed IRAs tend to be more beneficial for to use. They have a lot of pros versus any cons. And there are also some flexibilities, I guess I would call them, that you can have with self-directed IRAs that you can't even get in the other kind of IRAs. So if you are truly considering investing through yours or someone else's IRA, I would strongly recommend that you talk to the IRA custodian as well as a tax professional and see what those risks and rewards are as well for you to use that money. There is something called, well, it's kind of tongue-in-cheek, called a checkbook IRA, and it's pretty literal though of what it actually is. You can literally write your expenses right off of a checkbook like you would out of a regular personal account with this certain type of IRA. So that's something to talk to your custodian about as well. Steve, do you have any input on the IRAs in particular, any type of them?
Just that most IRA accounts, unless it's self-directed and unless it's with certain kinds of companies that work with that, aren't going to really allow you to invest specifically in real estate. If you have just a conventional IRA, you can borrow money and then invest, but there's rules about doing that as well. But if you want the best combination of things to work with investing in real estate, you want to be looking at probably a Roth IRA with a custodian that works specifically with real estate. Okay. And that's a really great way to go.
Okay, very good advice, thank you. Now, the conventional lenders are the ones that most of you are most familiar with. That's when you go to a bank or a credit union or a mortgage broker and you do an application and they either pre-qualify you or disqualify you right up front. And if you get pre-qualified, then you go through that longer process of verifying assets, income, anything like that, with the exceptions of there have been years when the lending rules were so loose that you actually didn't have to get any verification, even on some investment properties. That's part of what caused a lot of problem with banking, though. So I don't know if we're going to see those types of loans again. And they were very easy to use, but unfortunately that type of loan product was abused. So other than those type, which are the no income, no asset loans, now you generally have to verify income and assets. And you always get the best rates if you verify both of those anyway. But if you can get in the position where your credit is good enough, and good enough, it depends on the lender and what their requirements are, but generally a credit score of 620, some lenders 660 is their minimum. If you're right in that, you should be able to qualify. And then 10 to 25% down as a down payment. And if you say, well, I don't have that, just keep in mind that there are some of these properties like rentals in certain states that can be $100,000, so 10% down if you get one of those loans, that's only $10,000 versus some more expensive ones. If you have to put 20% down on a $300,000 place, coming up with $60,000 can be a lot tougher for a lot of you. So that's where partnering with somebody else who has a little bit more liquid cash or maybe has a nice IRA that they can borrow from, and they could do the loan and they can be the money partner that way. That's a possibility too. But just be prepared that these lenders are going to ask you a lot of questions, and you will have to do a lot of verifying. So be patient in the process, and don't give up hope. They do change the rules from time to time. That is without a doubt. It's tough for any of us, even people that are in the lending world, to say exactly what the rules are. They generally have to look at what the lender says at that time, because they can literally change overnight. So sometimes those rules are tough to keep up on, and that's another reason we recommend you get in good with at least a couple of different lenders. If you have a banker that is your favorite and you want to just stick with them, that's okay. But it's okay to shop around your loans as well. Maybe check with your bank, check with a couple of mortgage brokers, and whatever those regulations and rules are, if they fit in line with what you have, then with your income and assets, if that can also fit in line, then you're golden. If not, at least after you talk with them, you know where you're short. And then that's where you can work to get in a position so that maybe in 6 months or a year from now, you can go ahead and buy that rental you've always wanted. But go ahead and meet with them, just because they're going to be able to give you the best advice, and because things do change so rapidly. Steve?
Yeah, so if you find that you don't qualify for a loan for some reason or other, if you can kind of nail down what that was, if you look in other places, you might not have to deal with that particular problem. So there are some lenders, banks actually, that do what they call portfolio loans. And basically the difference is that on a regular conventional loan, they are going to take your loan and package it with a whole bunch of other loans and sell it on the secondary market. And in order for them to be able to sell to somebody like Fannie Mae or Freddie Mac, they have to go by their guidelines, Fannie Mae's guidelines or Freddie Mac's guidelines. And so because they have to obey or follow their rules, rather, they can only do certain types of loans. So if you don't fit into that scenario, they can't do your loan unless they do a portfolio loan, which is one that they don't sell, they just keep it in their own portfolio. And not all banks do that, just some do, but they're usually a lot more liberal on their requirements, but they also cost you a little bit extra money. And another alternative is to go to a mortgage broker. It's different than going to a bank. If you go to a specific bank, they've got a set of what they'll call products with their requirements. So each loan is referred to as a product, and they've all got their own specific requirements. And they're limited to whatever the bank does. If you go to a broker, on the other hand, a broker can shop hundreds of different lenders who have different requirements for things. And it might be that whatever's hanging you up would be okay at a different lender. So you might want to check into looking at a broker that might have a lender available that could do what you need to get done.
Mm-hmm. Very nice. And just to encourage you guys, when he says it's going to cost a little bit more, that's true. But if you guys think about, all right, what if I even had to pay a whole % more to get this done, but I make $30,000 on the deal? Is the extra couple $1,000s in interest really going to matter? Probably not. If you're going to hold it for long term, say 30-year, a 30-year mortgage on a rental, yeah, maybe that's something that you want to avoid, depending on the cash flow. But maybe you don't, because when rates get better or your credit gets better, then you can refinance in a couple of years. So just because it's a little expensive to go in one way, it's better to get a yes and make a little bit of money than to get a no and not make any money, right? So get started where you can and do what you can, and then think about the options in the future as well. And a lot of times, if you're getting these loans, when we're talking about a little bit more money, you're not holding it for 30 years. You might hold a rental 10, you might hold it 30, but a lot of people might rent for 10 or hold the property and keep it as a rental for 10, and then do a 1031 exchange and maybe upgrade into a different property. So you're not necessarily locked into whatever you have right up front. And if you're doing techniques like fix and flip, then you're not holding it very long anyway. So paying even 14% interest on a hard money loan, it sounds kind of scary because the number's high, but when you calculate it out for the year, it's really not that bad. So keep it in perspective what we mean when we're talking about you're going to pay a little bit more to get certain loans done. Is it better to make some money than none? I would say yes. What would you say, Steve?
I agree. Some's always better than none.
Yes. Yep. And it gives you experience too. You know, these things, you guys, they're not just for getting in there and making a little bit of money and it's all about the money. It's also about your portfolio, your experience. It's about a lot more. It's also about hopes and dreams. You know, a lot of these things people don't do just because they're scared. So if you never take a risk, do you really win? I don't think so. Now, conventional lenders usually require this big long list of stuff. We'll let you look that over at your own leisure. And it's also good to just talk to them anyway, but just know that the money is out there. This one just happens to be one of the tougher ones to qualify for because you have to have that big long list that fits their criteria. Usually they're going to close in 30 to 60 days, so you need to keep that in mind too, because if you have, let's say, a wholesale deal and it's super competitive and people are offering cash, you're not going to be competitive if you say you need 60 days to close and other people can offer to close in 5 to 7 days. So repeat clients tend to go a little bit faster. If you've worked with the same bank or the same mortgage company before, it might get done in 3 weeks instead of 4 to 6, but it's still longer than cash will be. And you should plan right now on an average of about 45 days for the loans to close. And then also consult with your realtor anytime you're using a realtor to go through the process with. If you're making an offer through the realtor, they should know roughly what loans are running at any given time because they're dealing with their clients getting these approvals. And it does change year to year. Sometimes we're running a really good solid 3 weeks for almost everybody, and other times we're really running a solid 5 weeks. And those 2 extra weeks can make a difference in your offer as well, how long you can tell the seller that you need, and you have to ask for that on the offer. And most sellers don't like to extend too long, so if you get overambitious and ask for 3 weeks and then you actually need 5, that doesn't look so good. However, if you know that you need 45 days-ish and you ask for 45, everybody stays calm and it looks like you know what you're doing, and you get a good reputation that way. Now, hard money is it's less accessible than conventional loans just because there are fewer of them. There are banks all over the United States. You know, every few blocks in some cities, you've got another bank. The hard money lenders are people that usually just have their own cash. Sometimes it's a few of them that have pooled their money together, and then they loan the money out. They loan it out at a higher interest rate than the banks do, but it's also much faster and easier, and therefore for the convenience that you pay for being able to do cash offers and get the money very quickly, you're going to pay for it in points. Usually points and interest. You'll always pay interest. And there is a type of lender called a transactional funder that will sometimes just charge you points and no interest. So that can be a little bit confusing if you're new, but just know that points and interest are the standard. About 2 points, which is 2% of however much you're borrowing, so you can calculate that pretty fast. You need $100,000. That's only $2,000 up front. That's a hard cost. And, well, I say up front. Sometimes they literally require up front when you get the loan, but a lot of times they'll take it out of the loan at the end. So it's a requirement up front that you're going to pay it. That's something you agree to. But when they take that money, that can vary a little bit. It is a pretty large risk because if you don't meet the short deadline that they have, usually they'll only lend 3 to 6 months max, and some are only for a month at a time or 2 months. Some are renewable terms, so you get in there a month and then sometimes you can extend, but the risk of that gets a little bit sketchy. So I recommend, and I want to hear from you too, Steve, but I recommend you try to find a lender that'll let you go about 6 months, and then maybe have an extendable clause where if you need a little bit longer, you can just pay them the interest on that month, and then if you need another month, you pay that interest so you can continually go until whenever they say their drop dead date is. But that's the risk, is if you have a lender that either number one won't extend, or maybe they only extend up to a year and your property doesn't sell for some reason within a year, then they take the property back. And it doesn't always have to be a year. If they have a 3-month term, they might say drop dead at 3 months. You might be overconfident thinking you can get it done. So my caution is you get a hard money lender that will lend longer than you think you're going to need, and that they do have an extension clause in there. Even if you do have to pay some extra money for it, at least you don't lose the whole property. Steve, what do you have about that?
Well, I would give the same recommendations that you did. But one thing I would want to add is that it would be a good idea to have several different hard money lenders lined up, because they do have different requirements, and every deal will present different opportunities or problems to solve. So, for example, the most important thing you may need in a particular deal is to get a higher loan to value, and so the other terms might not matter as much. In other situations, it might be that you need more time, and so you'll need to have a lender that's open to longer time frames, or at least renegotiating the deal without simply just foreclosing on it. So if you have a variety of people to work with and they've got different terms, you can pick and choose who's going to be available for a particular deal. And the other piece of it is that because a lot of these guys are private money, they don't have unlimited sources, and sometimes it takes a while for somebody to free up their money. So I had one I worked with that would only have money about every 6 months because his deals were so good. You almost had to just get in line, and then when he had money available, he'd give you a call and say, "Hey, I've got money now. What have you got?" So just get a group of them together, just like you'd have a bunch of different buyers if you were a wholesaler, and then apply whatever lender it is that you need to put on any particular deal.
Excellent.
Just opens more doors for you.
Okay, very good. Thank you.
And yeah, one last thing. It says very large risk, but then underneath there it looks like as risk as a plus. And what is meant there is that the liability with a hard money loan is actually limited to taking back the property. And it's one of the reasons why you can use hard money loans in working with IRAs. If you have to get funding, you can use IRA money for a down payment, but you have to do that with a non-recourse loan, and that's what hard money does. They'll never come on you personally if the deal fails, and so that actually limits your risk. So that's it.
Thank you. So those lending terms, just remember they can be as short as a month, and some will actually go up to 24 months, with 3 to 6 being the most common that I've ever found. And those short period risks are the biggest risks out of doing any deals with hard money. Most of the guys out there that are going to lend the money are going to be honest, but there are going to be some that are a little sharky, so I also recommend you trust your guts. If you don't feel good about it, look for a different lender, because they're not all 100% honest. That's not scary. It's just to say trust yourself more than being hungry for the deal, to just say, oh, the numbers look okay, but I don't feel so good inside. So make sure that it's somebody that you feel comfortable with. A little bit of nervousness is normal, but yeah, just be careful. There are some out there that would be happy to take your good property back, and then once you've done the work to fix it up, they can turn around and resell it. So just be cautious. So the speed of the loan and the easy qualifying are definitely the biggest pluses with the hard money lenders. Now with your private lenders, they're some of my favorite because they've got that nice happy medium. They've got generally lower interest rates, maybe not as low as conventional loans, but their terms are a lot more flexible. Sometimes they hardly have any terms. It's just how good the deal is. It can literally be as easy as hard money saying, here's what we're buying it for, here's what we're fixing it up for, the ratios are good, and so the deal is good. And they'll say yes, even though they don't know you that well, or maybe they don't know you at all. But the deal itself looks good, and that makes them comfortable. And usually there are no minimum or maximum lending amounts other than what they can afford. So they don't say, oh, we're not going to loan on something that's only $40,000. Where with hard money lenders, sometimes they do say anything under X amount we just won't loan on because they don't make enough money on it. Private lenders don't usually have that requirement. And you can see right here on this nice little graph that Steve put together for us how private lenders and hard money lenders match up. You can compare them a little bit here. So lower interest rate on private lenders, higher flexibility on terms, generally speaking. The loan max and minimum are generally not an issue, and they do just care about the quality of the project. So pretty good. Steve, do you have anything before we move on to seller financing?
No, that's good. Thank you.
Okay. Now, this is something a lot of people are pretty unfamiliar with. They might have heard about it, but don't really understand how it works. And let me tell you, if you find sellers willing to do this, it is like finding a golden nugget. A lot of times, people don't even ask the sellers because they think the sellers will just say no. They assume too much that the sellers need money out of the property, and that's not always the case. Some sellers don't. So with certain seller financing techniques, you may not even need to get any kind of other loan. They will finance the whole thing literally. I just helped somebody do that last year. They had been renting a place for a couple of years. The sellers were getting ready to sell because they were at the end of their five-year window. And this relates to the rule that if you've lived in the property 2 of the last 5 years, you don't have to pay capital gains taxes. But they were coming up on their 5 years. The people had rented almost 3, and the people couldn't quite qualify for a loan. They were super close, but the wife had a little bit better credit than the husband, and they were working on bringing his up to qualify, and they figured they needed about 6 months. Well, that timing to sell didn't work out too well with the seller, so they wanted a house they could buy, these tenants. The seller wanted to sell, and so what they could do then is a seller finance deal, and the seller could get what they needed, which was to meet their deadline. They didn't need the cash out of the house. That's one example of how this is kind of a technique can be really advantageous to all parties involved. So there is usually, not always, an existing mortgage on the property, but there is oftentimes equity in the property as well. So you have an underlying mortgage, some equity at the top, and then how the sellers need to use that equity when they sell is dependent on their situation. They also might have equity in other investment properties, and when you're trying to negotiate with the seller, maybe you have equity in other properties that you can offer them as collateral. So this goes both ways. This is a very nice technique for you guys to use when you're selling properties. It's also nice when you're buying properties. Different types of seller financing: wraparound mortgage, lease options, a seller carryback, where they wait for some of their money. They're literally doing what it says in the wording. They're carrying back some of that money and holding on to it for a while. And then the land contract and a subject to. So we offer that seller financing webinar. It's a series, a 6-week series that covers all of these different techniques. And at the end, we do have a promotion on that as well. So we'll tell you a little bit more about that. But if you're interested in learning how to leverage sellers' money, equity, credit, everything that they have in their property, or pieces of what they're willing to leverage, this is a great webinar series for you. Now, investment partners can be phenomenal, and they can also take you down. So be very, very careful that you put everything that you agree to in writing. Investment partners bring all of their experience and all of their wonderfulness with them, their skill sets, their enthusiasm, just a lot of really good things. But I've seen partnerships go really wrong between friends, family, and people that became friends but then weren't at the end of working together. So in order to avoid court, in order to avoid fights and having relationships ruined, the more that you can come up with at the beginning to put in writing, the better it's going to be. And try to think of all the best case and the worst case scenarios so that you can cover them, like death, disability, fraud or embezzlement, anything that would be a problem. And what I recommend you do is talk to an attorney, especially, again, here, like Steve mentioned before, talking to somebody that has experience in real estate. You might have a really good CPA, but they don't deal with a lot of real estate investors. You might have a really good IRA custodian, but they don't really deal with real estate that much. Same thing with attorneys. Attorneys are definitely experienced in different types of things more than others. So I would recommend that you find somebody who's done real estate partnership contracts before, and you're not their first one. Steve, what you got there?
No, I think you covered it well.
Okay. So this part, Steve always picks the best pictures. I love these. So you don't want to feel like that little guy in the middle with the sharks around you. You just want to make sure that you're protected. And just like with anything else we're going to ever teach you, whether it's seller financing or negotiating with for sale by owner, it doesn't matter what you're doing. You should always try to make sure both parties are protected. So look at it from every angle that you can, and then, like it says on here, just make those plans for the worst, just in case, but of course, always hope for the best. Now, anything that you change in your partnership as you go along, and I will admit this is something I have personally gotten burned on in my younger years when I didn't do it. And so I'm going to be a strong advocate to say definitely make sure that anything you verbally agree to gets put into the contract. You can always do an addendum to any contract and add things later as you go, because situations change. Life changes, people change, so it's just important that you continue to adapt your contract as you go, because anything that's not in writing really doesn't exist. So let's talk for a minute about how you're going to get through some of the mental part of this. It's kind of scary, right? Asking other people to finance your deals. If you weren't a little scared, I think maybe you didn't have any nervous system or something. It's a little bit intimidating at first. So how do we recommend you get over that? If you've ever had a business where you had to do any kind of dialing to get sales or talk to people face-to-face to get sales, it's really the same situation. You're going to have no's. Not everybody will say yes to you. Even if most people say yes, somebody's just not going to be interested or have the money or have the guts sometimes to do it. So some people are scared of real estate. They just literally don't have any interest in being your bank. Other people, they get it. They understand. And their risk tolerance factor can definitely be better. Everybody's got a risk tolerance factor. Some are very high on the risk tolerance and they're willing to take big chances, and others are very conservative. So knowing who you're dealing with can be very, very helpful in the way that you present to them in the first place. You're going to tend to get more yeses if you know if you're presenting an opportunity to a conservative person. You'll want to focus on the safety in there, how good the deal is. Make sure you have all of the numbers run well 2-3 different times. Have your comps in order, your comparative market properties that show what other ones have sold for, to show the value is there. So treat them actually a lot like a bank, where you're saying, here are all the reasons. Here's my verification. Here's my identification. Here are my credentials. Let them know why they should feel safe with you. Other people, they're not going to ask you that many questions. You know, they're the ones with the high risk tolerance, but some people with the low risk tolerance, they're going to have a lot more questions for you. Here's one little technique that I found worked really well for me. When people would ask me a question that I didn't know, say, well, let's see, what's one early on? I'm trying to think back. I remember sitting in someone's living room literally and having them ask me something like rate of return. It was something that was dealing with the numbers, and I wasn't very good at running the formulas yet. And so I said, that is a really good question. Let me find out, and I will get back to you tomorrow. And so that was a way for me to let them know that I was willing to find out. I just didn't honestly know. And it's always better to say that kind of an answer than to make something up that's not true. Steve, do you have anything on yeses and nos and how to prepare mentally?
Yeah, just keep in mind that, you know, there's people that do this sort of thing for a living, and if they're not making loans, they're not making any money. So they do want to make loans. They want to say yes to you. And there are other people that would love to be able to get into the real estate investing business, but they don't know how. And maybe they've just got $5,000 that they would like to do something with. And that's not enough to really, you know, buy a rental property and hang on to it, but they might be able to work with you, and you might be able to put their money to work and help get them in the game. So don't be afraid to let people know what you do. Don't be afraid to let them know that you can put their money to work. Don't be afraid to let them know that you can help them succeed in this business. And not everyone's going to say yes, but there's going to be some out there that really want to work with somebody like you. So be open to that. Give them the opportunity to say yes.
That's really nice. Give them the opportunity to say yes. That's really what you're doing. It's that thing where if you never get up to bat, you're never going to hit a home run. You have to get up to bat. And so if you don't give them the opportunity to say yes or no to you, you've already gotten a no. It's an automatic no. So just remember that every single no is okay. It means you're doing it, number one, you're presenting. And number two, your skills are improving as you continue to present. And one day you will get that yes, because just like it says, every no is a step closer to yes. Absolutely. That is absolutely true. Now, Steve, do you want to run over this cash flow example?
Sure. So this is just an example of somebody who buys a property for $120,000, and then we're looking at what could you make out of that over a period of time. So if I have to come up with a 10% down payment, $12,000, I'm going to be financing $108,000. If I can get a 4% interest rate, which you can realistically if you're depending on who you're dealing with, but in this case we rated it out at 4%, which will give you a monthly payment of $516. If you were able to turn around and rent that property out for $900, and you're paying, which is a very high percentage rate, if you're paying 20% in expenses, you'd be losing $180 off of that $900. So the cash flow for the tax ends up to be $204. So I take the $180 and I add it to the $516 for my monthly payment. That leaves me $204. If I hold on to that for a year, then I'll be making $1,248. That's on the cash flow. Go ahead and move to the next screen. So I take that $1,248, and to that I'm going to add the appreciation that my property goes up in value over that period of time. Now, in a lot of areas, a pretty decent average over a 10-year period might be 10%. So if I'm looking at that at $12,000 per year, so it's averaging 10% per year. Well, some years it's going to be higher, some years it's going to be lower. Right now, in a lot of areas across the country, it's really taking off, and we've seen some slow years, but it's going to get even better before it straightens out again. But we're looking at $12,000 a year. After 10 years, that's going to average out to $240,000 in appreciation. My house will be worth more, $240,000 more than what I paid for it. And after 10 years, the total value of that deal is going to be a combination of the appreciation plus the cash flow I was able to accumulate during that period of time. And so if I add that to the base purchase price, I'm going to get $252,480 for my deal for that 10-year period of time.
Excellent. Thank you. And that's how you guys can make that long-term wealth. Because if you think about all of the rentals that you could pick up, even if you just did 1 year, that might not sound like a lot a year, but if you've got cash flow and appreciation every year, multiply that by however many rentals that you can pick up and hold, now you've got a really healthy retirement and you've got properties that you can pass on to your kids. So what we're going to suggest you do is take an inventory of whatever funding sources you already have yourself. Do some online research to find potential investors around your area. It's pretty easy when you do some of those Google searches. If you don't love Google, whatever kind you do. But let's just say that you Google and you put in private money lenders, Montana. hard money lenders, Dallas, Texas, whatever it is, wherever you are, put in private lenders, hard money lenders, conventional lenders, mortgage companies, anything that brings up something to do with lending. And here's what I would really recommend you do is don't rule anybody out yet. I like how Steve put it, that there's so, there's so many sources out there, and it really does depend on what they have at the time and who's available. Just because it's a no the first time you call them, let's say it's a hard money lender, and they say, no, we really don't like that deal, that doesn't mean in a few months or a year down the road they're not going to say yes to you. So keep the contacts. Call and ask them. We do have a script where you can interview hard money lenders and find out exactly what you need to know about what they have, how much they charge, how long they're willing to lend the money, so the terms on the money. And all of that can lead you towards the people that you need. And if you have a big fat list of potential investors that you can go to whenever there's a good deal, no matter what type of deal it is, whether it's a fix and flip or a seller financing where they only will finance a piece of that, or your rentals, anything like that, then you can mix and match your lending with the type of deal that you found. And then we also recommend that you just interview them using the script and find out what it is that you are missing, and then either get that yourself or find a partner that has that and come together so that your missing pieces can help each other out. A lot of the people that I've used as partners to fund deals, they have full-time jobs and they either don't have the knowledge to do real estate deals or they don't feel they have the time or the energy. So no matter what they're lacking, sometimes if they have the money, you bring the other pieces of the experience or the time and energy to go find the deals, or both, and then you guys can make a very good partnership that way, whether it's an official partnership where you do a company and you have company paperwork together, or whether they're just a lender for you. And they are two different things, completely different. So in one, you're sharing everything, and in the other, you're responsible to pay them back the money plus whatever that interest or terms is that they are requiring as the lender. So, Steve, what do you have to say on all that?
Well, just something that I've been thinking about here is that, with hard money lenders and private lenders, most often what they're interested in is having a secure deal. So it depends mostly on the property. So if you're getting told no, get clear on the reasons why. And the reason why I say that is that we tend to kind of take no as a personal rejection, and then it makes us a little bit gun shy about going to talk to that person the next time, or even to talk to anybody. But recognize that most likely what's happening is they're saying no to a particular deal, and that it's not a personal thing at all. And if you take them a better deal, you'll probably get a yes. So just keep that in mind as you're going to talk to people about these kind of things. And if you get told no, make that a learning experience. Figure out why and what you could do to make that change.
Amen. Okay, Steve, do you have any final comments for everybody?
No, just, it's been a pleasure being here. I hope you got something that you can take away from this to improve your outlook on things, or strategies that you might be looking at doing, or maybe even get the incentive, the courage, the whatever, to jump in and start getting some serious traction on real estate investing. So that would be our hope. And we would love to be here to help you out in any way we can.
Amen to that. You guys have a wonderful week, and take care of yourselves. Be blessed.